Good morning, everyone. It is Monday, the 6th of May 2024, a bank holiday here in the UK at least, and here's my blog for the week. So in this edition, I'm going to look at a couple of different things. First of all, a crazy trade that we've been in for quite a long time now on Spotify. And secondly, I'm looking at what months to put expiration dates in when we trade. So let's get started. It's a very light week for news this week. There's nothing earth-moving about, so we can quickly pass over that. Company news, Paramount again. Sony and Apollo Global Management, APO, have proposed a $26 billion all-cash deal to acquire Paramount, potentially merging major franchises and addressing the decline of traditional media sectors. And wow, Google paid Apple $20 billion back in 2022 to remain as the default search engine on Safari. But that is being looked at as potentially monopolizing. So we'll see, there's going to be a case on that. A New York Community Bank, great earnings saw its shares jump 30%. And they seem to have a plan in place for going forward. Meanwhile, CVS shares fell 16%. When the company missed its Q1 earnings and revenue targets. It's also prompted a reduction on its full-year profit forecast, and this is apparently due to rising medical costs. Philips, the Dutch company, hit a two-year high. Its shares surged 46% after reaching a $1.1 billion settlement in the US for a sleep apnea device that it had to recall. Just a reminder from last week's incredible news, the New York Stock Exchange are considering 24-hour trading, and currently market participants are being polled on the idea. We're way into the middle of earnings season, so there's loads and loads of earnings coming out. So I've actually just put them in on the stocks that I'm looking at for the dance card. We'll see those shortly. And the market indices. TICN, if you might remember, last week had over 10% increase in its index. It's took 1.28% of a backward step this week, so just give a little back. Meanwhile, the S&P, NASDAQ, and Dow Jones are all up. I still know which one I want to be in. The TICN index is up by 135 points overall. The best of the others is the NASDAQ, even with those tech companies in it. Since the end of March 2020, it's up 110%. And of course, that doesn't give people the advantage of premiums for selling puts and calls that we get. And I've got an interesting trade for you. Despite all of the filters on picking trades, this one worked. It's Spotify. It's got a value line score for safety of 3 and for timeliness of 3. Its financial strength is just B+, and it has never been a TICN 4x4 stock. It's in the industry of entertainment and ranked at 83, although I really do think those industry ranks are not very good when you have the likes of Match.com and Etsy both as internet companies. I would imagine Spotify is also an internet company. Then we've got the price to earnings ratio, no meaningful information. The current price is $296.07. That's a 17.24% multiple if you want to buy the assets. And its forecast is $229, so downwards in the next 18 months, but in the 3 to 5 year period, $375. And this stock doesn't pay dividends. So the 100 Millionaire Club bought one spot contract and paid $150 per share. And they were put to the club in 2022, October 2022. However, they got a $22.40 put premium. That's going to help. And they did pay $1 for a protective lid, so they lose one of those $22.40. They sold a second put that didn't trigger, and that brought in $16.60 per share more, and they've sold 7 call options, giving a further $15.86. So the total income is $53.86. That brings their exposure down to $96.14. And with the current share price at $296, they are $146.07 up. I think we can probably get that to 100% very shortly. So filters are filters. I don't think back using then, it was probably the best of trades to take, but it's worked out. These days, using all the filters, I probably wouldn't even look at it. Thereby probably hangs a message. And these are my stock filters. Now, those that are highlighted in yellow, these are new. Some of them I'm not even using yet. I'll be using them in the next week. So let's have a quick read through them. First of all, we want to see a full value line report. Sometimes they're not full. There are only 1,700 companies that get a full report. I want to see a value line timeliness score of 3. Remember, 1 is high, 5 is low. So 1, 2, or 3 is good. Same for value line safety score. I want to see a 1, 2, or 3. On the TICN quality system, for quality, I'm looking at 30. For value, I'm looking at a minimum of 40. I want the stochastics to be below 20 or to have just been below and crossed over. Similarly for Wilder's RSA, below 30 or having just crossed over. I don't want earnings to be due out in the next 2 weeks. I don't want to be dicing with what happens to earnings. We simply don't know which way the stock is going to go, irrespective of not knowing how much the company will beat or fall short on its earnings, on the predictions. I don't want to deal with really cheap stocks anymore. $5 is my minimum. I have a very flexible maximum of $100. I want the price to earnings ratio to be 20 or lower, and I want the price to book value multiple to be 3.5 times or lower. Now I use the risk to reward ratio. I'm using the 52-week high and the 52-week low. And by taking a figure of approximately 35%, I'm saying, therefore, that based on the last 12 months, the stock's got basically scope to grow by 2/3 of its value. Current assets, this is new. I want them to be at least twice current liabilities. I don't like long-term debt. I don't want that to be more than 50% of the capitalization of the company. Now, you can mess about looking at saying, oh, it's that sort of industry and it's structural and so on. It's not a problem, but I'm not going to bother with that. I just don't want it to be more than 50% of capitalization. Thank you. There are plenty of other stocks to go for. Growth, and this comes from TICN. I want the 5-year earnings projection for to be higher than the 5-year sales growth projection. And profitability, I don't want any losses posted for any quarter in the last 3 years. Now, really, I would prefer 4 or 5 years. And I'm taking into account here the shutdown, the lockdown for COVID. And in due course, I may well increase that 3 years upwards. Then looking at the premiums available for selling puts, I'm looking for an annualized return on capital employed of 80% or more. And another new one is open interest. I want that to be at least 300 at the time of taking the trade. The reason for that is that if I want to close the trade early, for any reason, but hopefully because it's in good profit, then there's got to be scope for the brokers to be able to sell the thing on for me. And that needs to have me not trading by myself. And then diversification. I don't want any position to represent 5% of the account value or more. And I don't want not more than one stock per industry. Now, industry is a difficult thing, but I'm particularly concerned about retail hard lines, retail soft lines, and retail online. And similarly, airlines and precious metal mining and oil. there will be other sectors that I don't want to have more than one stock in too. So this week's dance card, here it is. And I've extended this also. So you can see I've got the stocks in place there, and you can see that the VLT is the value line timeliness score, VLS is the timeliness safety score for value line. We've got TQ is the TICN quality score, TP is the TICN price score. Headroom, that's how much space the thing has got based on its 52-week high and 52-week low for me to see an increase in the price. The price to earnings ratio is there. The price BVPS is book value per share, and that's the one that I don't like to see too high. And the multiple is therefore using the price and that BVPS to find out how many times the price is worth the assets of the company. And then I've got the earnings dates highlighted, and a lot of them are coming up this week. And then I look at the stock buying power, and I have been looking at the open interest. It's fine on each of these, or it will be by the time we come to actually make a trade. So I've got strike prices and I've got months. The ones that are highlighted, that's a question of there is currently low open interest, and I want to check what that is at the time of trading. But it will probably go up, so I'm not eliminating them from our inquiries at the moment. Now, something else I'd like you to notice here is that not every stock has puts available for every expiration date. In fact, I don't think there's a single stock here that hits all of the expiration dates. Some, of course, have weekly expiration dates, and I think there's some now even with daily, but I haven't put the weekly ones in. So just sticking to the monthly ones, you can see there are gaps. And I'm going to turn now to look at which months we should be looking at to sell puts in. And I think of this as a series of buckets, and I've represented the capacity that I want to use for trading as being 3 $1 bills. It's obviously a lot more than that. So I'm not interested normally in selling puts for the next 30 days, that's the next month, or the next 60 days. After that, I do like 90 days, 3 months, 4 months, 5 months, 6 months. But let's see what happens. So just take a single trade. It's got a return on capital employed of 35%. That's using the premium against the stock buying power. And when I annualize it for the number of days involved, if you're doing 90 days, that goes up to 142%. I like it. However, the same trade at 120 days, the annualized return on capital employed begins to fall. And if you go way out to how many months is that? About 12, we're down there 38% annualized return on capital employed. So over the course of a 5-year program, which of course our clubs are, that means you could only use the capital basically 5 times. Now let's also think about once you've filled whatever number of buckets you want to fill, we've got our little question mark and a cute little guy there. What can you do at that point? Well, if you've already filled all the buckets you want to fill, whether that's 4, 5, 6, 7, or 10, all you can do is fill the next one that becomes available. Now, that's all things being equal. There is the case, of course, that we've got those gaps. So you might go out a little bit and use some of the future dates, knowing that new puts will become available to fill in some of the gaps that we saw on that last slide. I'll just go back for a moment to it. Yeah, so some of these gaps, they'll get filled. New puts would become available. So that could save the day. Other than that, I really don't want to get stuck into a process that only ever allows me to get a very low annualized capital employed on the put premium. You might recall from the slide I've done earlier, I'm looking for 80% as a minimum. So that's how I think about which dates to use as expiration dates. Next week, I'm going to dig deeper into that expiration month selection and see what exceptions I can find. So I'll see you then. In the meantime, don't forget, we'll be holding live training on the 21st, 22nd, and 23rd of June. On the 21st, it's just a Friday evening, and that's to do with live trading. On Saturday, the 22nd, we'll be spending the day looking at the factors that we use to filter these stocks. And on the Sunday, that's when we get into the really interesting stuff, new types of trade, new research, and so on. All of this is taking place at the Sofitel, Terminal 5, Heathrow, and you can book at myinvestmentclub.co.uk. On the front page there's a button that will give you more information and also tell you how to book. And a last reminder, if you haven't read it yet, have a go at my best-selling book, The Extraordinary Investment Club. It's available on Amazon, Audible, and 50 other publishing sites. And it's also very inexpensive. Anyway, that's it for this week. Have fun. I will see you next week.